Good morning. Welcome to our third Regulatory Insights webinar. The many challenges of the last year has forced businesses of all sizes to rapidly reinvent their operations, whether they were ready or not. The phrase the new normal has become commonplace as people try to imagine how a post-pandemic world will look and function. Business leaders today, however, must do more than just prepare their own people for the workplace of tomorrow. They must look to new areas of growth for the future. With this in mind, Altaf Abu of the JSE navigates the growth in the debt capital markets over the last 5 years. The pandemic has also starkly highlighted the importance of building trust for a strong economy and a healthy, well-functioning society. In many countries, organizational trust was in decline before the pandemic hit because many people do not believe that institutions have their best interests in mind. In light of this, I put you in cruise control mode for strengthening governance measures, including the need for diversity and inclusion, as well as summarizing important new amendments to the JSE listings requirements related to the integrity of financial reporting for the protection of your shareholders. Finally, although the pandemic, the economy, social conflict, and climate-related catastrophes may continue to test us, we cannot simply return to the way things were. Keith Rayner of KAR Presentations drives home the changes wrought to the regulatory landscape and also gives us some direction on the future. We have an opportunity to reimagine work and reshape the world so that future adversities are more predictable and manageable.
Good day, everyone. Today, I want to reflect on the debt capital markets in South Africa over the last 5 years. I will offer an overview based on a data-driven approach. While I may offer my own thoughts, the data is unbiased and will allow you an opportunity to reach your own conclusions. I will then attempt to anticipate what the next 5 years will hold and where the growth will come from. To kick off in this first slide, we're going to be comparing the growth in the equity capital markets to the debt capital markets. And as you can see, they're both been growing pretty nicely over the last 5 years. And as expected, the growth in the bond market is steady, while the growth in the equity market will have far more variance. The bond market in particular has grown an average of just over 10% per annum over the last 5 years. And in the last 2 years has actually accelerated to 14 and 15% respectively. The question is, of course, where's the growth coming from? And to start answering that question, in the next slide, we're going to be looking at the number of unique bond issuers. That's everyone from SOEs to banks, other corporates, and everyone in between. In 4 of the last 5 years, this number has been pretty stable, staying in the 120s, until last year when it fell to 115. Which, while not insignificant, still shows the robustness of the debt capital markets. And this probably provides the first clue or answer as to where the growth is coming from, which is that the same issuers are in fact issuing more debt year after year. In the next slide, we're looking at the number of new bond listings each year over the last 5 years. The bond markets tend to have a steady cycle, which was probably disrupted in 2020 as there was an expectation to continue the increasing trend that started in 2019. Though the number of new issuances in 2020 is still above the 2018 levels, that shows that while it has come off, it certainly hasn't been catastrophic. The drop in the number of issuers that I mentioned before will have a direct effect on the number of new instruments being brought to market. In the next graph, we can see the total amount of bonds listed on the exchange at the end of every year. And as we can see again, the market has been growing strongly, especially in recent years. The fact that there are so many bonds still listed in 2020 compared to 2018, even though there has been a reduction in new listings, indicates that there were much more longer 10-year bonds issued in the last few years. This could be an indicator of the growing confidence in 2018 and 2019 before the most recent crisis. There's of course the chance that we can see a return to this increase in confidence by the end of this year once we are through the health crisis. And with a lower cost of capital expected and inflation not anticipated to tick up for some time, there may be another significant bump in new listings come 2022. Another question that we always get is, are the foreigners coming or buying? Are they buying or selling or coming or going? And in this chart, we can see the green being the foreign purchasing activity and the blue being the foreign sales of bonds on our market. The net effect of these numbers make interesting headlines. But the truth is far more boring. And as we can see, the foreign trading activity in 2020 was almost the same as 2019, despite the health crisis and the ratings downgrade. Even though selling by foreigners marginally outpaced buying, they were still buying more and more every year in line with the growth of the bond market. Of course, this brings us back to the question of where's the growth coming from? And in this next slide, I've put together a simple model where I've shared the four major groups, if you would, of what makes up the debt capital markets. In this view, I've separated them into a green section on top, being the South African government, and SOEs, which I termed public debt. And the red section at the bottom is made up of banks and other corporates, which I termed private debt. Since 2016, the public sector made up roughly 80% of the debt capital markets capitalization, while the private sector made up 20%. That has been pretty steady until 2020, when the public sector share grew to 82%. The question is, of course, why did this happen? And in this next view, we have a mirror of the previous slide, but instead of percentages, we've measured in billions of rands. Both the public sector and the private sector have increased in line with the growth in the debt capital markets by around 10% per annum for the first 4 years. But suddenly in 2020, the public sector grew by 18%, while the private sector fell by 2%. The two most popular explanations we received are that corporates were just not able to get investors' confidence, so they didn't come to market. And the other were that corporates were putting off plans until the end of the health crisis. On the other hand, government was required to plan for an expected drop in revenue and an increase in spending. Investors seem quite happy to continue to invest in which are still good rates for a guaranteed or risk-free instrument, well, in rands at least. It's also worth noting that the only sector not to increase borrowing over this period is the SOEs, which have fallen out of favor with investors over the last few years. So, where to from here? Where will the growth come from? Will the private sector borrowing kick back in? And will the ratio of public to private borrowing return to pre-crisis levels? Or will the crisis leave a permanent change in the makeup of the bonds market? I'll leave the speculation to you, but where I will offer some insight is on where we can anticipate the growth to come from over the next 5 years. The first is a drive by investors for increasing sustainable investing. This is a bottom-up drive that has been pushing issuers. And the second is a massive top-down South Africa macro or government-led push for infrastructure. I see these two as the major growth factors over the next 5 years, and I'm going to go through them at a very high level. Last year, we launched our sustainability segment, which expanded on our green bond segment. This now includes green, social, and sustainability bonds. We're also looking at several more sustainable investing instruments which are grabbing the market's attention. This segment has been growing steadily since its initiation as a self-labeling sector to a fully endorsed sustainability sector. And in the last 5 years, this growth has been over 30% per annum. The other sector that I mentioned is infrastructure. The health crisis once again brought to the forefront the realization of just how underinvested we are in infrastructure, from housing to healthcare and education, energy and water, and even transportation. There have been talks of around 200 to 700 billion in infrastructure investment that needs to happen. A significant portion of this will have to be funded through the debt capital markets. The government will also not be able to share this burden or opportunity alone, and the private sector will have to be involved. This will mean an increase in borrowing both in the public and private sector for infrastructure. What the mix of this will be is difficult to anticipate, but it will be significant. We're looking forward to this being another driver of both our economy and the debt capital markets over the next 5 years. I'd like to thank you for taking the time today, and hopefully I've added some value.
Good morning, my name is Sajol Roy. I will be talking about some key changes to the JSE listings requirements. The JSE has made a number of changes to Section 3.84 relating to corporate governance. Firstly, the JSE has mandated that the auditor reappointment be subject to shareholder approval at the AGM. Secondly, they have changed the elements of the board diversity policy. Finally, the CEO and FD have to make substantive responsibility statements in the AFS. All of these changes are effective for companies whose financial years ended on 31 December 2020 or later. It is important that listed companies review, enhance, or develop processes to meet the new governance requirements. Starting with Section 3.84G relating to the appointment of the auditor, the new point 4 effectively states that, notwithstanding the provisions of Section 90.6 of the Companies Act, the Audit Committee must ensure that the appointment of the auditor is presented and included as a resolution in the AGM for shareholder approval. Section 90.6 of the Companies Act allows for a retiring auditor to be automatically reappointed without shareholder approval, barring certain conditions. As it is already standard practice for listed companies to seek shareholder approval for the reappointment of the auditor at the AGM, this change should be easy enough to comply with. If your auditor appointment is voted down by shareholders, then the company will need to begin the process to terminate the mandate and inform the JSE within 24 hours of this decision. Your auditor will inform the JSE separately of this and also within 24 hours. As to whether you need to announce, this is at the JSE's discretion. The Audit Committee must then consider the information as per Section 22.5H of the listings requirements when appointing a new auditor, both initially and thereafter annually. The company must then inform the JSE within 24 hours of the decision to appoint a new auditor, and an announcement must be made. Details of these changes must be included in your upcoming AFS. The next item of discussion is the board diversity policy. The JSE listings requirements previously mandated that boards consider just race and gender in the appointment of directors. Looking at the changes highlighted in red on the right-hand side, these elements have always been included in the King Code. However, the JSE allowed companies to focus only on gender and race. With this amendment, when appointing directors, the board is required to consider not just gender and race, but the broader elements of culture, age, field of knowledge, skills, and experience. Then, in the annual report, it must disclose on how all broad elements of diversity have been considered and applied. Furthermore, the annual report must also include an explanation on the elements that were not considered. The inclusion of diversity targets remains voluntary, and therefore, if your company does have targets in place, then a progress report on these targets must be included. Generally speaking, the skills, expertise, and experience of individuals are the largest considerations for the optimal board. However, diversity and inclusion are a priority for many organizations in both private and public sectors across the world. Diversity and inclusion are particularly important in South Africa, where the legacy of exclusion is still prevalent. Corporate leaders used to note that shareholders weren't clamoring for board diversity and were focused only on results. But now we are seeing that a diverse leadership team is as capable, in fact, more capable of delivering results. Looking at Deloitte's latest global stats on diversity and inclusion, from 26,000 South African firms surveyed, only 11% had top management that were Black African, whereas 62% of firms had white senior management. Out of the 277 JSE listed firms, only 19% of directors and 29% of top management were women. 45 of the 277 listed companies had no female representation. To make the case for diversity, a diverse board brings a wider range of perspectives to the boardroom. This leads to greater understanding of the customer base and operational markets, which means that the board is better placed to find and act on opportunities, which ultimately creates value for the business. For example, in 2014, Walmart appointed the 30-year-old co-founder of Instagram to their board. They needed technical and digital expertise to connect with a wider range of customers and enhance e-shopping and mobile capabilities. This is especially important today and the way in which we contact business, virtually and contactless in this global pandemic. Research was conducted with boards that introduced a 40% gender quote. And it was found that female directors were more likely to ask deeper questions, probing the issue at hand, resulting in more robust board debate. A 40% gender quota also served to eliminate cliques being formed and in fact leads to wider networking. Finally, diversity can enhance the external perception of a company. I think it is imperative for companies to be hyper-aware of the power of online platforms like social media available to consumers. Diversity at the highest level of a company may also be perceived as outsiders as adopting a top-down approach to good corporate citizenship, inspiring investor confidence and ultimately creating value. Finally, the JSE has introduced Section 3.84K to the listings requirements. This is a statement to be included in the AFS. Essentially, the CEO and FD must sign responsibility statements affirming the accuracy and completeness of the AFS and the adequacy and efficacy of internal financial controls. Let's break down the statement by paragraph according to further guidance provided by SICA and the JSE. The CEO and FD responsibility statement must be made by them after due, careful and proper consideration that the apps fairly present in all material respects the financial position, financial performance and cash flows of the company in terms of IFRS. This is unchanged from previous requirements. The JSE wished to reinforce the wording after due, careful and proper consideration, which requires that directors take active steps as expected of any executive director exercising their fiduciary duty. Materiality must be interpreted in the context of IFRS, meaning a user must be able to make economic decisions with confidence based on the financial information presented. In summary, executive management must attest to the fact that the apps have been prepared in accordance with the accounting framework and are suitable for reliable economic decision-making. Point B states that no facts have been omitted or untrue statements made that would make the annual financial statements false or misleading. This suggests that if a fact, transaction, or circumstance is omitted, then this will not impair the decision-making ability of the user or render the apps to not be a fair representation. The JSE also clarified that the term no does not mean 100% factual correctness, but rather, after due, careful, and proper consideration, the directors agree that no facts have been omitted or untrue statements made that would make the AFS materially false or materially misleading in the context of IFRS. Point C requires the FD and CEO to confirm that internal financial controls have been put in place to ensure that material information relating to the company and its consolidated subs have been provided to effectively prepare the Fs. The CEO and FD take ultimate responsibility of the functioning of the internal controls over financial reporting, whilst the board of directors remain ultimately accountable. An amount can be described as material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that users of the apps make. The term material is as defined by IFRS and must also be interpreted in the context of the size of the entity and financial and business risks that could affect financial reporting. Point D relates to the adequacy and efficacy of internal financial controls. Principle 15 of the King Code states that the governing body should ensure that assurance services and functions enable an effective control environment and that these support the integrity of information for internal decision making and of the organization's external reports. The term adequate suggests that the internal financial controls are relevant and appropriately designed and executed to prevent or detect material misstatements, omissions, or obscuring of financial information. The term effective suggests that the internal financial controls are reliable and achieving their purpose. The JSC clarified that internal financial controls relates not only to the preparation of the AFS, but to any other interim, provisional, preliminary, or forecast report. This statement means that if weaknesses are detected in the internal financial control system, then the FD and CEO have to disclose this to the audit committee and the external auditor. The FD and CEO are also responsible for ensuring that the deficiencies have been subsequently remedied or measures have been put in place to do so in time. The JSC understands that remedial action is an ongoing process, and as such, the remedial action need not be fully implemented at the time of signing the statement. It should also be noted that the listings requirements does not require an external auditor sign-off on the control environment. The emphasis is on transparency and proactive monitoring, the outcome being that the control failure does not occur again. It is strongly recommended that detailed records of any fraud or intentional errors are maintained and included in the minutes of meetings with the audit committee and both internal and external audit. Finally, on the actual signature of the FD and CEO, the JSC has clarified that the statement must be made exactly as set out here and cannot be changed in any way. However, they will allow companies to include additional supplementary information, such as what controls it has in place or what deficiencies were found. To this end, the JSC will permit such additional wording only provided that this does not attempt to nullify the meaning and intention of the CEO and FD sign-off. This final requirement should be seen to allow for greater transparency by executive management and not as a mechanism of trying to disassociate from any of the requirements of the statement. Thank you.
Good day, everyone. My name is Keith Rayner. I'm going to be dealing with the amendments to the JSE listings requirements. This webinar is a continuation from the last webinar I did in last year, May, and we'll be dealing with the COVID-19 guidance and the amendments to the listings requirements. So dealing with the first topic being the COVID guidance. What the JSE did last year in conjunction with the FSCA was provided extensions with respect to the compliance with regard to periodic financial reporting. This dealt with year-end reporting, the issue of audited annual financial statements, and also interim reporting for the interim period. The extension for the year-end reporting was 2 months. This particular 2-month extension period applies to the issue of audited annual financial statements, which means they only have to be issued 6 months post year-end, which also affects provisional reporting, and they only have to be issued 5 months post year end, and interim reporting was given a 1-month extension and needs to be issued within 4 months of interim period end. Both of these extensions apply to the latest financial year ending of end July 2020. So this particular guidance letter is now time expired. Moving on to real estate investment trusts. The property sector went through some torrid times last year and currently as well. And with regard to real estate investment trusts, REITs, again the JSE together with the FSCA resulted in the FSCA issuing a notice in June last year allowing REITs an extra 2 months in which to make their annual distributions to their holders. And this is a 75% payment of distributable profits. This particular extension period of 2 months resulted in REITs having 6 months post year end to make their distributions, and this applied to years ending up to the end of September 2020. So this guidance letter is still live. Dealing with property entities and trading statements, property entities deal with forecasts of future profits and losses by using a distribution per share, a DPS, disclosure baseline in their trading statements, which is triggered when a 15% change occurs versus a prior period. Given the tension and problems in the property sector, a number of property entities, REITs or otherwise, ceased or deferred distribution payments, which means the DPS is no longer a relevant baseline measure for trading statements, and this guidance letter then requires such property entities to adopt an earnings baseline or net asset value per share baseline. This does require announcement on SENS, and such announcement would also be in the form of a price-sensitive information announcement apprising the market of the change and providing particulars of the problems being experienced. Moving on to one of the various and numerous financial disclosure guidelines issued by the JSE. This particular guideline dealt with accounting and auditing disclosures, and on a granular basis required full and detailed IFRS disclosure of estimates and judgments, financial instrument disclosures, and the disaggregation of segmental reporting and revenue reporting, and included an expanded COVID-19 financial analysis disclosure platform, which is allowable in terms of IAS 1, and this is able to be effected in short and long form periodic reporting. Just a warning on this: if any financial analysis results in the disclosure of a pro forma number, that requires sign-off by a reporting accountant if it's done on an annual platform, but not for an interim time period. Moving on to specific issues of shares for cash. Again, the JSE engaged with the FSCA, which resulted in the FSCA issuing a market notice allowing for specific issues of shares for cash resolutions to be able to be passed on a round-robin basis. This would also have resulted in an amendment to the MOI of any list co that chose to proceed with this particular scenario. This, however, is now also time expired because it was a limited approval up until 31 December 2020. The final COVID guidance letter was issued in September, and it was a broad minimum-based disclosure guidance letter dealing with continuing obligations and capital raisings. So firstly, with respect to continuing obligations, the letter emphasized the continual requirement to make price-sensitive disclosures on SENS to apprise the market of any price-sensitive issues during the time of COVID. The guidance letter also picked up on trading statement guidance and noted that true minimums should be used in a minimum-based trading statement and not merely the 20% threshold. With regard to capital raising focus areas, we have a disclosure and consideration given to rights offers. With respect to disclosure, there's an emphasis on business insights to describe the state of the LISCO business, cash flow disclosures, material loans, and material risks, particularly in circulars. With regard to rights offers, guidance was given that intention announcements might be problematic in that they commence with a speculative timeline. So the JSE was recommending terms announcements of rights offers without intention announcements. There was an emphasis placed on underwriting disclosures and also a caution warning the market not to provide price-sensitive information to insiders ahead of the announcement of a rights offer. That concluded the COVID-19 matters I'm dealing with, dealing briefly with proposed amendments. The first one are amendments to our timetables, which involves a number of new principles being introduced. It is quite a detailed memorandum that was issued, so I leave you to read that for yourselves. Some examples of the principles included therein are rights offers and rounding, secondary listings and an extension period for dividend options, and the issue of new securities must be made in DMAT form. So all of the comments will have been received, and we now wait for the JSE to finalize and issue the new timetable schedule. Then finally, the headline earnings per share circular has been reviewed, and there will be amendments made to it, most importantly relating to leases. Again, comments have already been received, and we wait for the issue of the new circular. I thank you for that time. That concludes my presentation.
Thank you so much for joining us today. We hope that you have found the series to be both insightful and relevant to you. If you have any further queries, please feel free to contact us at the email address shown on the screen. Look out for invitations to our next web series, providing you with even more regulatory updates.